Good morning. I'm Todd Healy, and along with my partners Carolyn Smith and Celeste Moya, we'd like to welcome you to another version of Coffee with C3. This morning, we're going to talk about behind the curtain with life insurance planning. This is part two. For those of you that were not on the first one, it's not mandatory that you listen to it first, but it is on our website. And with all of our calls, we will end at 8:45. However, in the past, we've not been able to take the questions because of the time constraints. So if you have a question that you want to ask and you put it in the chat room, if we don't get to it, we'll stay on for a few minutes afterwards. But for those of you that need to drop at 8:45, we certainly understand, and you weren't hurt our feelings. So with that, Carolyn, if you'll kick us off, please.
It's so good to virtually be back together this morning. You know, looking back on my years as a tax partner in public accounting, my areas of focus were continuity and estate tax planning. And then, very sadly, also working with families after a death occurred. Life insurance, as you may have imagined, was often part of the plan design. Today, after 11 plus years partnering with Todd, Celeste, and the rest of the team, I've come to realize how much more there was to know about products and designing a portfolio. In reality, the simple truth was I didn't know what I didn't know. So as Todd said, our mission this morning is to take you backstage on products and definitions and help you see why it's so important to review this valuable asset. One of the questions I was often asked by executors trustees during my CPA days was, where is the money? Because as you know, wealth and liquidity, well, they're completely different. And if you take today's world with rapid opportunity, along with continuous regulatory tax changes, the need is increasing for this planning. Or perhaps said another way, having a plan for where to get the money provides the much needed peace of mind. Oh, I almost forgot. We've got a little disclaimer I've got to show you. Okay, in our opinion, today's asset protection and diversification planning has personal, as you can see on the screen, as well as business needs that are more important than ever. Our next Coffee with C3 on June 10th will go front stage on these topics. But for now, first things first. Celeste, can you share what the various types of life insurance are?
Absolutely. Thank you, Carolyn, and good morning to everyone. Really, in the life insurance space, there's two buckets when it comes to the types of life insurance. It's that we consider temporary coverage, which you all probably have heard as referred to as term insurance for a limited need. And then we have what is permanent. A lot of people sometimes say, I'm looking at term or whole life, and really whole life, as you can see on this page or on this screen, it's just a type of permanent coverage. And there's other types of permanent coverage. There's various versions of universal life, including universal life, variable universal life, index universal life. And even among those, there's still some subcategories that we can dive even deeper into. But let's look a little bit closer at term insurance. Term insurance is a crucial part of the planning that we provide for the clients. And sometimes it's not given the importance that it needs to be given. We compare term insurance to renting because it's only for a short term of time that somebody will need it. Generally, that's going to be, 10, 15, 20-year terms. There's some other terms available, but those are going to be the most common that we use in planning scenarios. The premiums are guaranteed. They're not going to change during that particular term period that is selected. A really important component, and one of the things that's overlooked with term insurance, is that it protects our insurability. When you buy in term insurance, you're technically locking in that medical class that you are in at that time. And so by medical class, we're referring to those risk classes you may have heard as like preferred or standard, non-smoker, or smoker. When you buy that term insurance, you're now protecting that risk class so that if something changes in the future, you can convert, which is another aspect of the policy. You can convert your policy into a permanent policy policy without having to go through that underwriting, that medical underwriting again. And very important when there is a health change. Conversion is another crucial component of a term policy. Once again, it gives you that opportunity to move into a permanent policy at that permanent policy premium and at the age that we are at the time. Now, important to know is that conversion options vary among all term products. Just because you have a 10-year term doesn't mean you can convert for the entire 10 years or exchange it, for the entire 10 years. So really important to be aware of what those options are, and for whoever's doing this planning to stay on top of that option for you. As noted here, it's also affordable. It's, lower premiums than with other types of life insurance. And it's really focused on pure protection. This is a death benefit product, does not build any cash value. Lastly here, we have this chart that kind of exemplifies term insurance as far as what we refer to as the net amount at risk, which is the difference between the cash value and the death benefit. And since there's no cash value, the entire amount is what is referred to as a net amount at risk. And Taji, you want to share a little bit about whole life with us?
Sure. Thanks, Celeste. With whole life, with permanent insurance, we have a portion of the policy that's building up equity. It's a contract that is permanent. The contract can't be taken away as long as premiums are paid. With a permanent whole life contract, the premiums are guaranteed. Oftentimes, there are going to be dividends and cash accumulation that allow the net amount at risk, as Celeste referred to be reduced, and therefore the charges are reduced each year. Often dividends are used different ways. They can be guaranteed. Dividends are not guaranteed, but they can be used in 5 different ways and choices at the company's discretion. And finally, it's a little bit more expensive. It's not as flexible as the next product, which we'll talk about, is universal life. And as we look at universal life and compare it to term insurance, we see the big differences are cash accumulation in the product. And as I mentioned, that cash accumulation has the effect of reducing the net amount at risk based on the interest rates. As interest rates change and those rates drop, which they have historically, the cash value is less than projected. And what we see is the net amount at risk has increased. So in the next slide, we see that cash value has gone down. As a result, the net amount at risk has gone up. And we refer to that as a double-edged sword, because with a less cash value, there's less money being generated in interest and additional costs coming out in the product. So if premiums aren't adjusted, it could be that the contract terminates before the client wants it to, if it's not monitored properly. We have universal life that's got a little bit more flexibility. It's got a little bit flexible death benefit, more flexible than a whole life contract. It has the same moving parts as far as cash value, and it does give more flexibility because the money is going in a general account of the insurance company and it's being invested at the insurance company level. They can adjust the cost of insurance, the interest rates, and the expense charges. So as we look at the fact that there are limited guarantees, we go to the next policy, which is a variable universal life or indexed universal life. And this is reflecting what's happening in the marketplace. It's really important to note that these interest rates are going to be fluctuating as the market does, often a point-to-point change, typically 1 year to 5 years. It's going to also be possible that the rate will change as the indexes change, and there are different indexes that are available. It's important to note, as the footnote says, that you're not directly investing in the market. It's a shadow account of the market. So those are the couple of key points. And 2 last points is, number one, there's a potential upside on the cap for the insurance company set that can be changed. Along with that, there is also a guaranteed floor below which the insurance companies won't go. So you have the upside protection as well as the downside protection on the guarantees.
And on the variable universal life, so the kind of the third type of universal life product has all the same fundamental components as that universal life, index universal life that Todd mentioned. The major difference here is going to be the investment options. And so now this money is actually directed into the market, into particular investments that are selected. We refer to them as sub-accounts that are selected by the client or their advisor that make sense based on their particular level of risk tolerance. As you can see at the top, there's multiple ways that those investments can be, or that premium can be directed depending on their risk tolerance. There is potential for higher returns because you don't have the cap that you have with an index universal life. But on the flip side, you also don't have the floor. So in a down year, there is potential to, have those negative returns within the policy. It's really important that the client has that proper investment horizon to be able to adjust to the volatility that the product could potentially produce. But it definitely does have the option for these higher returns. And really important is the safety of the separate accounts. These are outside of the insurance company's holding. And so if there's ever any issue with company insolvency, creditor issues, that money, those assets cannot be touched by any of those outside organizations. But as noted, this is a product for somebody that generally has a little higher risk tolerance, has a broader investment horizon, so it's not suitable for all. Probably one of the most important products to establish suitability. I recently read an article that said, can life insurance be fun? And the bottom line was that absolutely it can be. As you can see, there's so many different options and products and ways that we can design it. The important and most important aspect of what we do is ensuring that we're finding the right solution, really understanding those goals and objectives on the front end, because then we can make this a really great design that fits into the client's planning. And that ultimately, as we maybe not as fun for everybody, but it's definitely fun for us.
I think, Celeste, what in a way you're saying too is that we really build a portfolio. It's just not one type of product, because you may have a short-term objective and a long-term objective. So I think that's where, quote, the fun happens on our side. Well, we thought it'd be helpful this morning to kind of summarize what Todd and Celeste have been sharing with you on the different types of life insurance. Some of you may have seen this before, but we continue to get great feedback on it, so we continue to make it available. On the types of life insurance, this is a front and back one pager that just lists all the types of products that are available. Now, carriers are going to use all different types of marketing terms, but when you boil down the layers, you're going to get to one of these products. Now, these are not in alphabetical order. They are listed from term, and then we go to all the permanent, and they're listed in range of complexity. So we start with the simplest of whole life, then universal life, etc. So again, they list in layers of complexity. So your client when you're visiting with them, what their level of complexity is. So this will be kind of a cheat sheet way to look. If they're way back here on the back, then compare that to as your client's tolerance. We wanted to go a little bit farther today and also provide you a glossary of key terms. You may have heard these terms, or you may use these terms in a different way in life, but these are the definitions for these words for insurance purposes. Some of the questions we get is, what does lapse mean? Or what is a reinstatement? What is a rider? So we just thought we just took the most common terms that you as an advisor and a client need to have a clarity on. So we wanted to provide that this morning as well.
And it's important to point out too that all the products listed are products that we are able to provide to our clients. We're not restricted by carrier or product. And finally, as we wrap up, this is an article that Carolyn has recently updated entitled, "Will Your Life Insurance Policy Die Before You Do?" And noted in the blue box there is a quote that we often refer to, which is the fact that life insurance is usually the largest unmanaged asset in the client's portfolio. So we will make that available to you. We'll make these slides available to you for those of you on the call. And if you want additional one-pagers that we've referred to, let us know. We can also send those separately. Our next Consume and Converse is next month, May 18th. Faresh is going to be talking about, are you running on empty? Gives us some tools and techniques to help deal with what's going on in our day and time, and some technology tips. And then in addition, we're going to talk about in June, as Carolyn referred to, the front stage asset protection, and talk about some of the ways that these products are used for both business and personal planning. So with that, I think we have about 30 seconds. I don't know if we have any questions before we formally close the program. Lisa, Rebecca, anything that's come in the chat room that?
Yes, there is a question, is when should you consider an individual policy versus group coverage?
Okay, I think the answer is to the extent you can get both, do both. When you're younger, the group coverage is much, much less expensive than it is when you get older. We have found that clients, once they get over, say, 50, the group term insurance is often more expensive than individual term and doesn't have the same flexibility. Carolyn, Celeste, anything to
I would
add?
say, and in today's mobile society, as you leave that employment, you leave
Right.
behind that insurance, and your insurability may have changed due to your medical history.
But I always say also maximize on what you can get from that group insurance, because it's
Right.
going to be, cost effective. So while you have access to it, particularly if it's some kind of term coverage, get as much of it as you can, but definitely supplement with something that's portable and that you can have. For the rest
That
of your
you
life.
own, that you
Right,
control.
right,
Yeah.
exactly.
So for those of you that are leaving or have left, we appreciate you being on the call this morning. For those that want to stay on and ask any other questions, it looks like we have a couple more questions in the chat room. Lisa,
They're more just comments. I think they're just comments. They were thanking us for our time and for the.
There were some other questions if you want to address those as well.
Sure. If we still have folks on the call, let's do that, please.
Okay, so how are the premium dollars invested in the general account portfolio of an insurance company?
That sounds like a Celeste question.
Yeah, definitely. I was just going to say that.
So in a general account, companies are extremely restricted as far as what they can invest in. Generally, it's in very conservative bonds. So insurance companies have to allocate a very high percentage of premiums in a fixed account or directed to those conservative bonds, which, as you know, have earning much less than they did in the past, hence why interest rates have dropped within products. Why we've seen a lot of product changes as well. And then they have a small percentage in which they have some discretion, a little bit more risk tolerance as far as investments, but the majority of it is going to be super conservative, which from a consumer perspective is great, because you know that your insurance company isn't out there aggressively investing those premiums and putting it at risk. There's also a lot of layers of protection from reinsurance, a lot of other things that protect those premiums. But that's kind of the gist of it. The majority is in those very conservative bonds, and hence why insurance companies have been so impacted by the lower interest rate.
And then policyholders have been impacted because the carriers, as you mentioned, have been paying so much less. And if you're not back to reviewing your policy, you can have a real a non-fun surprise someday.
Absolutely. Absolutely.
All right. Well, again, for those of you that are still on, appreciate your time, and we will get this recording out to you. If you want those handouts separately, we can provide those as well. And look forward to seeing you in May and June on our next events. Thank you all. Stay safe.
Bye-bye.
Bye.